What's going on, guys, and welcome back to another video. So today I want to discuss two main topics. Firstly, if I think there's a stock market crash on the horizon, and secondly, my plan of action to counteract this. So to discuss those two main topics, we'll break it down into four different sectors. Firstly, we'll discuss markets being cyclical. We'll have a look at my own trading 2-on-2 portfolio to see how it's actually performing over the last few days. We'll have a look at some interesting news articles, and finally we'll discuss my plan of action. The first point to note is that markets are cyclical, and a great way to see such an example is by looking at the S&P 500, which tracks the top 500 companies in the US. For this example, we'll use ticker symbol VUSA, which is on the London Stock Exchange and currently trading at £51.63. Certainly since the crash last March, the markets have mainly went in an upward direction, and for the last few months, even if you threw a dart at any stock, it nearly went up in value. So obviously the market was becoming in a bit of a bubble in my opinion. But over the last 5-day period, if you just looked at this chart solely, you'd be thinking it's a very worrying situation. But we'll discuss this actually is not a problem at all, and in fact it's actually quite healthy for markets to go down as well as up. So if you're looking for long-term investments, you obviously need to look at charts that are longer than 5 days. So if you just looked at this 5-day chart, again, it looked quite worrying. But however, if you go to the 1-year chart, it looks a lot more promising. And you can see, even though it was sitting at about £53 a share, it's gone down about £2 a share. But considering that this VUSA S&P 500 was sitting at about £38 or £39 last March, we're certainly still in a very good situation. So it's quite worrying to see a lot of new investors starting to panic in terms of the last few days that it's gone down a few percent. However, if you have to remember as well that prior to this, it went up a good about 5 to 10% over the last few weeks or months. So you have to kind of take the ups and downs in investing, and you need to keep your emotions out of it. For example, my own blue chip 30 company diversified portfolio, and again I'll emphasize the word diversified, because one of my main objectives or premises in investing was to get 30 companies, all blue chip, across all different sectors, to give me a well diversified portfolio. So there's no real kind of penny stocks or anything in this portfolio. You can see just on screen in communication services, I have Walt Disney and Facebook. So they're two well established brands. On screen now, you can see over here on the left how my portfolio is actually performing. Now, over the last 3 or 4 days, it went down about €250 or about 4% overall. Again, as my main premise of investing is the dollar cost average, I don't mind this one bit, as obviously markets need to go down as well as up. So in situations like this, we'll discuss later on what my plan of action is to counteract this. So it went from about €6,463 up about 10.5%, and we can see just over the last few days how it's starting to drop down. It went down to about €370, then it went down to 330, then 6,280, and currently sitting at about €6,211. So as I have all my pies split up into different sectors, we can see that communication service is still up 14.3%. However, the likes of consumer discretionary is down about 1.2%, and consumer staples is also down nearly 3%. Both of these I'll definitely be taking advantage of in dollar cost averaging. Again, we'll discuss this later on in the video, especially in companies like Coca-Cola, which I really do like their brand. We then have the likes of the energy sector. ETFs are all still in the green. Financials, healthcare and industrials all still are as well. Albeit it's worth noting that they were up a bit more a few weeks back, but again, markets are cyclical, so you need to take that on board. We're noting in materials, real estate is down about 0.7%, and my largest holding so far, tech, is still up 11.5%. After doing some research in terms of the stock market's current health, I saw some articles in terms of JP Morgan saying that the markets are too liquid and there's too much liquidity in the markets, which is causing a bubble that they believe will burst soon. But on the Motley Fool, there is a good enough article here, in my opinion, to give 4 reasons. So if we go back to the top, we can see that the stock market pandemic, that the reminders to calm your fears, and there's 4 topics that they discuss. So just the summary of these is to control what you can, focus on your long-term goals, especially if you're a long-term investor. You need to realize the markets are cyclical, and in turn, they need to go up and down. So you need to take advantage of when they're actually down, so that when they go back up to their highs, you have a better profit margin. You also need to shut out the noise. So again, when you look through or trawl through any forms of news articles, social media, you will see a lot of kind of hype and fear in the markets. Again, you need to keep this completely out of trading, as this could easily ruin your overall account. So for example, if you had, let's say, 10,000 euro invested and it went down 10% tomorrow, well, a lot of people in that case would panic and sell. However, if you actually leave it for another few days, you'll be surprised more times than not that it would actually go back up a few percent. So you wouldn't be down 10%, you might be down 5 or 6% at that time. And if you actually let it for the long term, it would eventually go back into the green. And you need to remember as well that you only lose money when you sell a stock. So keep them as long as you can, and you need to realize that they will eventually go back in value. And then the fourth point here kind of brings that into play as well, where they say you need to remember past stock market crashes. For example, again, just like March, where the markets tanked in a lot of cases, and a lot of people made money since then, and even since last March, stocks are still up vast amounts of percent. We can also see here on the Financial Times that the US markets have had their worst week since the middle of October. Again, this is nothing in my opinion to worry about whatsoever. The markets only went down about 3 to 5% overall. There hasn't been a complete tank in the markets, and I believe this is simply just market kind of consolidation and recovery. So this will always happen every few months or so. In some more occasions than not, it'll happen every few weeks, but in smaller kind of impacts than what's going on the past few days. So next we're going to discuss my plan of action over the coming weeks. So my two main plan of action over the coming weeks, firstly, is to not panic. You can still see here on screen that we are still up about 6.7% overall. So we're still healthily in the green at the moment. And I'll be just carrying on as normal and keeping out of the noise. And you need to realize that markets are cyclical. I know I said that a few times, but it's kind of a very strong point that you need to realize that they need to go up as well as down every few weeks or months. So again, as my main premise of investing is to buy companies when they're in the red and just kind of stick it out until they go back into the green. Overall, to help improve my dollar cost average, that's exactly what I'm going to continue to do, and I won't be doing anything different. My main thing is I certainly definitely won't be selling any stocks, as I believe at the moment is a great opportunity to buy some of these companies on the dip, such as Coca-Cola, Facebook, etc., and even companies like McDonald's as well, that are all in the red over the last week or two, and they're after going down a good few percent. So in my opinion, if you're a long-term investor or even a swing trader, there is definitely huge opportunities to make long-term growth. So that's pretty much it, guys. I just wanted to go through a few topics in terms of the last few days in the stock market and some news articles and my plan of action to kind of counteract the last few days as well in terms of the market dip. I do believe that the markets could easily go down another few percent over the next few weeks. However, you need to stay calm, and the best thing to do if you're a long-term investor is to dollar cost average, and don't, let's say if you have €1,000 at your disposal, don't invest all at once. Kind of drip feed it in if you can, so if the markets do go down a bit more, you're getting a better dollar cost average. And however, if they go back into the green, all the well, just keep that €1,000 on the sideline again until they go back into the red, as patience is key as a long-term investor. So that kind of brings the end to today's video. If you found it anyway helpful or entertaining, it'd be brilliant if you consider subscribing to the channel if you're new around here. And as always, if you could click the like button as well, it could mean a lot. If you have any questions, comments or queries, please don't hesitate to comment below and I'll be sure to get back to you. Thanks very much guys, enjoy your weekend, and I will see you all in tomorrow's video.